I think we've had the strong growth is the fiscal spending.
That was JP Morgan CEO Jamie Dimon speaking at the Economic Club of New York and ending there on that fiscal argument. Really good place to start our conversation with Daniel O'Keefe, lead portfolio manager of the Global Value and Select Equity Funds at Artisan Partners. Very nice to speak to you, Daniel. Thanks for joining us. And it's interesting, he was mentioning, Jamie Dimon there, mentioning the role that fiscal policy has played. And I know when you think about the US economy and the strong growth story we've seen this year, you think that part of the reason we haven't seen more effect from higher rates is because of that fiscal impulse. Explain a little more.
Yeah, I mean, it's very interesting. The market and a lot of business people are obsessed with this idea that we need to cut rates. But we're borrowing 6% plus of GDP on the fiscal side, which in my view is more than offsetting, the restraining effect of the interest rate increases. So we've got the best performing economy in the world. We're doing very well. Why do we need to cut interest rates? And no one's talking about the fiscal side of the equation when we're thinking about the U.S. economy. That's clearly driving the U.S. economy and clearly driving inflation.
Okay, so if we only get a couple of interest rate cuts this year, or dare we say it, if we don't get any interest rate cuts this year from the Fed, do you think stocks should be okay, sentiment should be okay, because it should be comforted by the fact that this is, to quote our colleague in the last hour, for good reason? It's because of U.S. economic outperformance.
Yeah, well, I don't think there should be any interest rate cuts. I mean, I think it's absurd. Maybe there will be, maybe there won't. I don't think there should be. We don't need them. The economy is being driven by a strong consumer. It's being driven by government stimulus, and earnings are leading the way. So it's a healthier market, in my opinion, for the market to be driven by earnings rather than interest rate cuts.
Daniel, stick with us for 1 second. I just want to bring breaking headlines coming when we're watching Caring now. The stock is now officially open, down about 8%. And of course, one of your major weights that you are seeing this morning, your biggest index, third biggest index contributor, of course, bleeding into LVMH as well. We're going to let a few more trades kind of help shake out, but just want to bring the initial pricing to our global audience. I want to bring it back from the macro conversation to that fiscal stimulus you were talking about from the States. This has never happened in history. We've seen this many rate hikes matched with this much profit growth. It's never happened at the same time. What happens when the fiscal impulse potentially abates in 2025, depending on who the next president of the United States is, or simply because of deficit issues? When does the market price that in?
Well, I don't know. I mean, there's absolutely no debate within the country, unfortunately, about restraining the spending. And it's unsustainable. It's clearly the major threat to U.S. economic dominance in the medium term. Trump never showed any fiscal discipline when he was president, and Biden has clearly shown none either. So I don't know what the end game is. Usually politicians only do the right thing when they've tried everything else.
Yeah.
And we're still in the process of them trying everything else. And so it will take a crisis.
So is that something you position for, though, or is this just not on your radar at all, given that we are just a couple months away, 8 months away from the U.S. election and about 9 months away from another debt ceiling conversation?
Investing is more about managing risk than about predictions, because predictions are almost always wrong. So we manage risk.
How are you managing that risk?
We focus on good companies and good balance sheets and valuations, and you don't get too optimistic and you don't get too pessimistic.
Okay. And with that in mind, let's talk about some of the big tech names, because a lot of tech names are reporting this week. I know Meta is one of the top performing stocks that you own. I think you still own, Daniel. What about, give us the best reason to pick this one over others, because a lot of people group either the Mag 7 or just the Magnificent 5 these days together. Why are you focused on Meta?
Well, I mean, we own Meta and we own Google, or Alphabet as it's called now. We like them both. They're great businesses. They're fundamentally very strong. The valuations are not particularly interesting at these prices, to be frank. But we believe in the businesses long term. We've been selling Meta recently. We trimmed it. It was a much larger position. We bought it significantly when it was down 70%, last year, or in 2022. And as it's significantly rebounded, we've trimmed it. But we like the business. We don't particularly like the valuation here, to be honest.
And do you want the company to focus on, a solid balance sheet and the P&L, or do you want them to be more experimental? These sort of seems to go in waves and cycles, and we see periods where the market tolerates quite a lot of spend on R&D, and then periods where the business gets the message and pulls that back.
Well, I mean, they're flushing a lot of good money down the drain, on this whole metaverse, and we wish they would stop. Other than that, capital allocation is very good. I think the metaverse is sort of an embedded option, in the valuation of Meta. They're spending $10-15 billion a year that's generating no return. If they stopped, the valuation would look much more interesting. We hope they do. But that's an option you're not really paying for right now.
Right, so you're not too worried. What about spending on AI? Would you put that in the same box, or no, that's what they should be doing?
No, I mean, their AI is going to be a significant beneficiary for Meta. It's going to help make their advertising algorithm more effective. It already is. Before everyone was jumping on the AI train, Meta was talking about machine learning.
Yeah.
And using machine learning to make their advertising algorithms more effective, and it's working. And I think it will continue to work. I think they will continue to be a beneficiary of AI over a very long period of time.
We talked about Meta. Let's talk about Alphabet as well. You said you have a significant position there. Is the bet on Alphabet a consumer-driven bet based on advertising, or is it a business investment bet? What's the bull case for Alphabet?
Well, I mean, their biggest business is advertising, right? Which is ultimately businesses using Alphabet to reach consumers. So it depends on how you want to look at that.
How do you look at it?
Well, I mean, it's driven by the advertising market, and it's driven by the continued secular shift of advertising towards online. I think that will continue. It's a very, very strong business. And AI, people get very excited about AI, but the truth is the profits are, for the most part, on the come. And businesses like Alphabet and Meta, for example, will use AI as a tool to make their businesses more efficient, more profitable, and better advertising mousetraps. So that's going to happen over a very long period of time. People shouldn't expect AI to, flip a switch and the profits start gushing.
Very quickly, what is that time horizon, though? Are we talking 5 years, 10 years, 50 for returns on that?
I think you will see AI play out over a long period of time, just as you saw the internet play out over a long period of time. So we'll be talking about it in 10 years for sure.
All right. Daniel O'Keefe there, lead portfolio manager of Artisan Partners, breaking down some of the nuances in the tech space as well. And as we talk about those heavyweights in the States, let's talk about the heavyweights right here in Europe. And I'm going to put my Guy Johnson hat or Guy Johnson tie on at the moment and explore the sensational six numbers, specifically because we're seeing the heavyweights actually underperform. The exception, of course, being ASML ahead of that big investor day. It's the only stock green on the screen this morning, higher by 2.4%. The LVMH story is interesting, though. That perhaps a read through from the carrying pain that we are getting. The carrying share is down still about 8%. LVMH down by 0.6%. You've got that consumer bid there and as well. Nestle down about 0.3%. I believe that later in the hour we're going to be talking about Nestle and the Unilever bid as well when it comes to that consumer. But again, it's that luxury read through that I really have my eye on. Is this a one-day thing, or is there more to it? Which brings us nicely into exactly what Joe Easton has got his eye on. Joe, walk us through what's catching your eye this morning.
So we're going to continue with that luxury theme at Critti, because Kering getting absolutely slammed over in Paris, down 9% at the moment. The stock is trading at the lowest level since 2017, following that massive warning after the market closed last night. As Anna was mentioning, we already did see a report around a month or so ago saying that sales would be weak, but it is much worse than expected, potentially double-digit declines in earnings estimates. According to analysts, they're not doing enough on the high-end space like Louis Vuitton does well in, and also the aspirational buyers not good enough either. That's the view from analysts. Seeing some read across in some of the other peers. LVMH, you mentioned Hermes, Moncler. Moncler does have earnings coming up later today out of Italy. That could be an interesting one. But the moves really not as much as we're seeing Kering. Hermes actually ticking slightly higher, potentially showing that this is really a Gucci story and an Yves Saint Laurent story, not so much a biggest read across on the market. But in terms of other read acrosses, we're going to look at chips, because these stocks are absolutely soaring today, the best performing sector by some stretch. Now we've got Infineon up around 7%, the best performer on the stock 600. ST Micro doing well, ASML as well. ASMI, the chip machinery firm, had a strong update, and we also got a bullish report out of Texas Instruments after the close last night. All of those boosting the sector today. Auto chips seems to be the big thing out of Texas Instruments, not doing as badly as expected according to them. Then a quick look at some other other earnings. We're going to start in the UK on these ones. So we did get Lloyds. This one was dropping, as you mentioned, at the open, down 2.8%. Another easing of net interest margins. Reckitt Benckiser, though, coming back up. The maker of household products doing well, did drop a lot recently, given worries about their baby formula unit. That's one of the worst performers on the London market this year, but it's up almost 4% today. Temenos cutting its sales forecast. Interestingly, they say recent short seller report is causing banks to cut back on their software, showing the impact of that Hindenburg report that we saw recently. So Temenos down another 6% today. And Volvo Cars, a surprising weak one because the auto sales, the EV sales actually looked pretty strong in the last quarter, but some concern around margins, the initial take on that one. And Volvo is down sharply today, down almost 7% this morning. Just one deals news to bring you. Allfunds, disappointment for investors for this one. It's a fintech firm out of Amsterdam. They do data and analytics for the wealth management business, and they're scrapping a sales process, and that is dropping that stock around 8.5%. The worst performer over in Amsterdam. Allfunds really hit hard this morning. Finally, one morning call. UBS once again. It gets a second downgrade in 2 days. This time it's Citi who cuts the stock this morning. They go neutral from buy, and that stock slipping at around 0.9%. Citi say the valuation is too full following a recent rally, and capital worries still linger, so they downgrade that one. And UBS falling once again, down over in Switzerland at 0.9%.
Thank you very much, Joe Easton there from our equities team with an update on what we're watching in terms of the market moves. There are so many companies on the move this morning. I just want to mention ASM International. I think actually Joe may have mentioned this one, but rising by 14% this morning, 13.7% as first quarter orders beat estimates, not to be confused with its other larger player within the same space. But that's where we are on the ASMI story in the chip space. Coming up on the programme, we'll stick with things Dutch. Beer volumes beat. The Dutch brewer Heineken reports higher sales for the first quarter. Details next. This is Bloomberg.
It meant that you always look different because you were the first woman, or the first brown person, the first Asian, the first Indian, the first person of color to lead a global luxury brand. You're always the first. You're always underestimated. People don't know exactly what to expect. They're suspicious of what your agenda might be.